Good evening, everyone, and welcome to the September Board of Finance regular meeting. Thank you to Simsbury Community Media for filming. Please join me in the Pledge of Allegiance.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
I do have a few updates, but I'll give them after we do the presentation with Fiduciant. Per Section 808 of the Town Charter, the Board of Finance is charged with supervising and maintaining the pension and other post-employment benefit systems and funds in accordance with rules and regulations contained in the agreements between the town and employees and in consultation with the Board of Ed and the Board of Selectmen. This presentation tonight by Fiduciant is part of that duty. Fiduciant reports to the Retirement Subcommittee 4 times a year and the full board twice a year. As part of this discussion, we'll be asked to affirm the current defined benefit and pension investment policy, and at this point there are no recommended changes, so it will just be to reaffirm what we already have. So with that, welcome you, ask you to introduce yourself formally. And let's get going.
Sure, great. Thank you, Chairwoman Haydener, and good evening, folks. Good to see everyone. My name's Chris Cashmore. Lots of familiar faces, of course, and great to see you again. I'm the consultant from Fiduciant that services your DB and OPEB plan. You'll remember my colleague Tyler Polk worked with you on the DC plan, and tonight our colleague Paige Thompson is going to be sitting in and providing the updates on the defined contribution activity. So I know we've got a busy agenda. We're going to dive right in here and hit the highlights for you and get you caught up. We had this.
Just before you start, we'll confirm for the record everyone has read the presentation that Chris has presented.
Yes.
So we'll confirm that for the record. Okay, go ahead, Chris.
Okay, so we'll be quick, and that's a great affirmation. So again, good evening, folks. Good to see you all. Very quickly, the update that we had shared with the committee, the retirement committee, a short while back. We won't dwell on this, but we will just quickly, from a perspective standpoint, hit a couple of highlights. The big narrative in the markets this year continues to be, as you all know, the Federal Reserve interest rate policy. Can they, in fact, stem inflation with rate hikes and do so in a manner that doesn't elicit a recession? And as you will see here, bear with me, I'm sorry. As you'll see here, through June, by and large, markets think they will be able to strike that balance. So we have seen pretty good returns for both the fixed income portion of the markets. The returns there you see in the upper left-hand corner of the page, the horizontal bars are calendar year to date through June. And then you'll see the equity markets in the middle of the page. They are pretty prominent and consistent returns there, noting the particularly good returns of the large cap U.S. equity arena. We talked a little bit about our retirement plan committee. We had a miserable 2022 calendar year, as you all know, and we have seen some relief in 2023. And again, against the backdrop that markets seem to be operating under the notion that we're going to get a slowdown in inflation, but maybe not an outright recession, or at least a prominent one, if everything comes together as hoped for. So that's the big picture backdrop. A lot of numbers on this page, and I apologize. I'm just going to kind of hit a couple of the high-level numbers for the committee, for the board. The pension plans year-to-date are each up about 7% through June. A similar number and outcome for the one-year number. So for the fiscal year ending in June, somewhere around 7%, a little bit north of that. There are small variations, you'll remember, in the returns that are a byproduct of just the receipt of cash flows and outflows and whatnot. But by and large, the numbers are consistent, as the 3 plans, as you all know, share the same allocation and portfolios, and those figures are down in the middle of the page there.
What page, Chris?
I'm on page 4, I think, of the deck. If folks can make that out, and for those listening in, as you'll see, square in the middle of the page there, the allocation structures for each of the programs, about 30% in fixed income securities, with the balance in global equities, and then a small measure of real estate for diversification purposes. No actions for the board this evening. We're in good working order from an allocation standpoint, and moreover, the roster's in good working order. We did share with the retirement subcommittee, and we'll share with this board, that at post-production, our research team did elevate Met West to watch. It does not require action this evening, but we are spending some time investigating some forthcoming retirements from their portfolio management team. We'll obviously keep you posted in real time on that, but again, no actions required from the board this evening. So performance stabilizing and certainly much more compelling than we had a year ago. Allocations across the three plans in good working order. Any questions from the board? We want to stay on pace here and on task, but anything that folks okay? And just obviously interrupt me if something arises. Switching gears for the OPEB. So you see here the OPEB, the construct, as you all remember, is a little bit different. This is an all-indexed program. You see the ETFs there that we use in the middle of the page. So we have a portfolio, right, that over time should mimic what you see there in the longer dated returns. I'm on page 5 of the materials, aligning with the broad markets. So on a 1-year basis, actually the program is up almost 9% for June in the fiscal year, and then the longer dated numbers, they're running aligned with the broad markets again, as you would expect. Allocations, pretty close to target weights, is expressed in the middle of the page there. As you all know, just as a reminder, we work with Amy on an interactive basis as monies come in and to deploy those efficiently. But again, we're in good working order from an allocation standpoint, and no recommendations for the board on OPEB.
Chris, how often does money come in? Is that monthly, quarterly?
I would say not monthly, Amy, right? Maybe a little bit more sporadic than that. Every couple of months we seem to get some money in, right, that we put to work. And you'll see there's a small measure of cash there right now. We might work that balance down with Amy. The nice thing right now in markets, as you all know, you're getting nice yields in those short money market funds and the like, right? So you don't really have that opportunity cost to traditional fixed income. But nonetheless, we'll get some of that money to work likely in short order. So that's OPEB. There's more detail in the booklet if folks have read it. I'm not going to dwell on it. What I did want to do quickly, I know the chair had asked us to, you'll remember that we use a governance calendar framework when we're reviewing materials with the subcommittee. So not only are we talking about markets and performance, of course, each and every quarter, but there are other things that we attend to as co-fiduciaries to the assets. In this quarter, you'll see upper right-hand corner of the page, as the chair mentioned, we do want to reaffirm the investment policy statement just as a matter of good practice. And you'll see there on page 11, we've highlighted for you what we think makes an effective investment policy statement, and reaffirmed for you that your policy statement, a copy is included in your materials, is in good working order from our standpoint. And as mentioned, no recommendations for that policy statement this evening for the board. But as a matter of record, I'll defer to the chair, of course, but maybe just reaffirming that we're in good working order and there are no issues or questions from the board.
If the clerk could just note that there are no issues or questions for the board, and that our recommendation is to affirm the current policy from our advisor.
Great. And then the last thing I'll do, and then I'm going to cede the floor to Paige. The other thing, just quickly, we won't go through all this, but the town has always been very good with this, right? In terms of best practices from a committee perspective, vis-a-vis the retirement plans, you really are doing everything and discharging your responsibilities in accordance with our notion of best practices. You've got good engaged committees with good experience. You're taking minutes. You're meeting regularly. You're reviewing performance and setting goals and objectives for the different asset pools, and we don't have any recommendations or concerns from a larger governance perspective. So just wanted to note that quickly. There was one last item, a question from the chair that I'll just fill in now because I'll forget to do it later. The state, you probably saw not too long ago, had sent a letter to every municipality across the state asking for information on investment policy statements, fee structures for your retirement programs, and some actuarial information, and obviously an exercise to gather data. I don't know what the ultimate purposes are. I won't surmise that, but we'll see what comes of it. Your fees, you'll remember, we review as a matter of governance each and every year as well. So today, the pension plans bear a little bit less than 1/2% of expense, which when we compare it across our 40 municipal clients in Connecticut is very competitive. The OPEB has about 1/5% of investment load, 20 basis points, call it. Again, very competitive. So just again noting for the minutes or the record, your programs from our standpoint as your advisor are very competitively and effectively priced, and no concerns from us on that front.
Thank you.
Is that, Lisa, enough?
Yeah, that's great. And for our clerk, if we could just include that statement in the minutes. All right.
Because either you or Paige, at some point, could you just address having a weaker year followed by a stronger year, what that does for allocation strategy, just as a recap, briefly, whenever it fits into your presentation?
Yeah, I can do it right now. It's a fair question and a good one. So you'll remember, as a formal matter, each fall, and we're coming into the season now, we dust off all of our capital market assumptions. We do a very deep dive across the entire investing universe, from cash all the way to emerging market equities and everything in between. And we're gauging what our expectations are from a return standpoint across all those asset classes for you folks on a go-forward basis, right? We're kind of operating with a strategic mentality. So we're not going to tinker with allocations dramatically, right? Because we're testing the larger allocation structure that you've got in place strategically, and does it continue to fulfill the objectives of the program? Balanced total return, something that's reasonable from the actuary's perspective and achievable, right? And trying to do that each and every year. It's interesting when we do that, we haven't done that work just yet, but when we do that work this year, we're going to come on the heels, as you mentioned, of some pretty good performance, particularly for equities. And I do think, all things equal, right, what that does is it probably on a go-forward basis actually reduces our expectations for equities maybe a little bit over the forecast period, right? Because we've gathered a lot of that incremental return in the current marking period, right? So when we're forecasting going forward, it likely brings those expectations down a little bit. Remember, it was the exact opposite a year ago. We had a terrible equity and fixed income markets, and our thought was, from a valuation standpoint going forward, we actually had incremental opportunities for return. So it's a dynamic process. It varies year to year. At the end of the day, as you all know, we've worked with the town for years and years and years. We don't make dramatic changes to the allocation, right? We're never going to come to you and say, this year let's put 40% in cash and 10% in equities and 30% in hedge funds, because that's what we think is going to do best this year, right? We're trying to stay true to a strategic allocation that's reasonable, that kind of recognizes the demographics of your asset pools and what you're trying to do actuarially and where you stand. And on the margin, as you know, we've done small things through the past, but it's never really dramatic. And that's by design, right? Because it's really difficult in a one-year period to forecast what might happen. We've got more confidence over 5 and certainly 10 years, and that's the kind of the vision and the framework we're trying to bring, and the perspective we're bringing to the board and to the retirement subcommittee to keep things on an even keel.
So what I heard was basically you like the allocation strategy, but there may be some harvesting of equity benefits and some movement into fixed income.
Yeah, I think when we come back to you at our next meeting and once that work's done, we could see a slightly reconfigured global equity profile. We may on the margin have a slightly different allocations we'll recommend, but we'll obviously stay in front of that exercise and bring it to you.
And you're watching MetWest.
And we're watching Michael, MetWest. So that's certainly the one manager in the pension programs that we're on an elevated status, and there is some stuff going on there that we're keeping tabs on.
Sorry, real quick, Chris, is it consensus among your colleagues that fiscal stimulus has worked its way through the economy fully?
I think stimulus, Derek, has. What I'm not quite sure of has, though, is the austerity from the Fed, right? I don't know that we've seen the full effects just yet of higher rates. They've gotten away with it so far, right? Inflation, the headline inflation has come down nicely. Labor markets are still strong. The consumer, by all accounts, by and large, is still in decent shape. So we haven't had some of those numbers roll over just yet. But if you look at things like leading economic indicators, right, we're on an extended 15-month run now of softer numbers. So it's not all rosy and perfect. And the jury is still out, right, because there's delayed effects, and the Fed knows there are delayed effects, right? So there's this idea that we're not sure yet how much damage we've done. Hopefully we haven't done too much. We'll see how that kind of all transpires. What you've seen more recently, I'll leave you with this, and you've read it, this higher for longer mentality now is starting to take hold from investors, right? Where, okay, maybe the Fed's done or close to done with rate hikes, but on the other side, if and when things start to get soft, they may be somewhat more reticent to begin to reduce rates quite as dramatically as they might have done in the past. And you've seen some of that in capital market outcomes over the last couple of weeks, right? Markets have been a bit softer in that kind of that narrative transition, if you will, for lack of a better term.
Thank you.
That help at all? Is
Very
that okay?
much so, thank you.
All right, I've probably way overstayed my welcome here, so I'm going to transition over to Paige,
Never.
and she's going to provide you a quick update on the DC plans.
You
And
could, yeah, thank you. Can you go to page 31?
Oh, it was in two different presentations.
oh, is that what it is? I was going
Yeah.
to say, I think I'm looking, Amy, at still all the DB stuff, right? $31, you said?
If this is just DC, it might be page 6. Let's see. A couple of different versions of the report. Okay, that's perfect, thank you. So following the DC fiduciary governance calendar, that lands us at the second quarter, which is our investment focus. And so today we'll be discussing menu design, taking a look under the hood on some of your investments like your QDIA, your target date funds, as well as your stable value. All your funds are on maintain, and there are no changes to the menu recommended, so nothing that needs to be decided today at this point. So moving ahead to page 8. We have the gap analysis, and so this is an exercise that illustrates your investment offerings in your plan, and we just use this as an exercise to just see where the opportunities are to make the menu better, and if the participants are utilizing the investments appropriately across the portfolio, and that is certainly the case here. We went through this with the committee, noting that your plan is very healthy. All the major asset classes are covered. You have active and indexing with throughout the menu. You have your target date funds, which is your designated QDIA option, as well as a managed account service. It comes to no surprise that the majority or good chunk of your participants are in the target date funds. We find that for a couple of our plan sponsors. On the next page, we have the benchmarking survey from Vanguard and How America Saves. And this showcases the percent of plans offering the asset classes you see at the bottom there and the bars, and then the percent of participants using the options when offered. And so this is the survey, but when you compare it to your plan, you can see that your plan is offering the top most utilized and utilized and offered asset classes within this survey. So you're certainly in line, and we have no recommendations or actions at this time regarding your menu design. Any questions? So we can move ahead to the QDIA analysis. We've included the T. Rowe Price Target Date Fund fact sheet, which we show every quarter. But just one thing to note that this year the manager added the hedge equity and dynamic credit strategy
within the strategic glide path. And so this was to help reduce any volatility within the glide path from major market shocks of 2022 and this year. And it's really paid off, which we'll see in a couple of minutes. But the other positive things that I highlighted for the committee is that through this strategy, you're able to get exposure to TIPS, high yield, real estate, emerging market equities, emerging market bonds, dedicated strategies that we don't offer in your core menu. So you certainly get it through your target date funds, which is a plus. And then on the next page, we've walked the committee through the strategic glide path. We have T. Rowe Price in the red there, the top 3 target date funds in the blue, as well as the benchmark in the black there. That gray line following the glide path are all the suites in the target date fund universe. And as you can see, the T. Rowe Price funds start out at 98% equity, a little bit more aggressive than the benchmark in the average top 3. Drops down to about 55% at retirement and then becomes a little bit more conservative at 41% post-retirement, but still a lot more aggressive than the benchmark in the average top 3. But we're comfortable, and this has paid off for them in the long run.
And Paige, can you talk about sort of the philosophy behind why they might do that? I assume it's people are living longer.
Yes, definitely based off of the participants living longer, and their focus is to reduce volatility and on long-term growth. So this is baked into their philosophy of the strategy as well. Any other questions? And we have the 5-year risk-reward profiles on the next page, and then the peer group is in the scatter plot there. And you can see based off the level of risk that they're taking in each vintage, they're beating out 90 to 99% of their peers in each vintage. So again, we are very comfortable with this strategy. If we take a look at the 2Q performance, which I'll get into in a minute, but just a quick preview that they did perform top of their peer group rankings for the second quarter. So again, we're very comfortable and no recommendations at this time.
Thank you.
I want to move ahead to stable value. Stable value fact sheet.
Sure. I'm sorry, folks, I'm a slow poke here.
It's okay. So we've included the fact sheet for the Mission Square value. You can see that they have their synthetic CIT stable value with a 12-month put, which we have on this page. Their market to book ratio, which really relates to the health of the stable value, although below 100% due to the market backdrop. They are still above the universe median, which we are comfortable with. Their credit quality is very good. And then on the next page, we have their crediting rate. You can see in the top left corner there, that chart. You can see that the crediting rate is in line with the universe median, but more importantly has increased since last year or even 2 years ago. So very comfortable with where their crediting rate is. And then we have their wrap providers on the bottom right there, very diverse and highly rated. So again, no concerns on your stable value, and we are comfortable with it as your capital preservation option. Any questions? All right. We have the market values for each plan within the DC plans. And so market values have increased. No concerns here and no sharp movements to particular asset classes. So it landed us at $14.8 million for the 457 plan, 1.3 for the Board of Ed, and about 1.1 for the 401A plan. And then so moving ahead to the target date fund performance, I mentioned that performance was very positive for the quarter. They're all on maintain, as I mentioned, but you can see the quarter 1 through 10-year net of fee performance. And obviously, it's all green there, so they're at the top of their peer group rankings as well. Their higher equity allocation for their strategic glide path was pretty additive to their performance in a risk-on environment. And so, that helped them there. And then also they had diversification within fixed income with exposure to high yield as well as floating rate, which outpaced the ag. So that was also beneficial. Within the core menu, all funds are on maintain within this menu as well. Indexes performed in line with their benchmark. So despite the peer group ranking performance, which we'll ignore for now, they performed very well against their benchmark. For the actively managed funds, any exposure to financials, energy, utilities, things of that nature struggled during the quarter, as those were the worst performing sectors of the market. For example, you see the MFS value at the bottom there. There was a mega cap tech rally in the first and second quarter of this year. And so think of names like Meta, Alphabet, Salesforce, Netflix, all were part of that rally, and not owning that stock really hurt the strategy a lot, as well as their stock selection and financials. On the next page, one of the funds that struggled a bit were Vanguard Explorer Value. And then again, same story here, selection in financials, healthcare, and energy hurt them as well. And then on 29, for the next page, we have Eden Vance that underperformed, and this was due to their overweight to financials. So similar story here, and then Hartford International's, their exposure to China, their stock selection in China hurt them a bit as well. So overall, there are no concerns. The strategies I mentioned have pretty great long-term performance. Again, all on maintain, so no concerns on the strategies mentioned with some problematic strategies this quarter, but certainly we'll watch it over time, but no recommendations at this time. Okay. Any questions from the board? We've included some of the calendar year performance as well, but.
Excellent. So if we could then go ahead and turn to page 65 in your packets. Are we ready for this? Do you have anything more you want to add? Are we ready to go to the motion?
I think we're ready.
Okay. We have before us, I'll go ahead and ask for a motion effective September 19th, 2023 to affirm the current defined benefit pension investment policy as presented.
So moved.
Second.
Is there any further discussion? All in favor, please say aye.
Aye.
Aye, that motion passes unanimously. Thank you. So is there anything we should be thinking about at this point? You're very comfortable with where we are?
Yeah, I think we're in pretty good working order on all the retirement plans, right? I think as a reminder for the board, as the chair mentioned, we meet with the subcommittee each and every quarter. We do pretty deep dives and pretty lots of conversation back and forth under Derek's leadership. And no concerns, no issues to note. A couple of things that we're monitoring, and again, we're coming into our cycle of dusting everything off and freshening up our expectations and what that may have in terms of implications going forward for the retirement plans. And we'll share that with you when it becomes available, and I suspect have another good and comprehensive conversation.
Thank you very much for coming. We appreciate it.
Thank you, folks.
Thank you.
I'll give a couple quick updates while Amy gets situated. First of all, and we're going to say it twice in this meeting, but I'm going to start off. Congratulations to Amy Lee, Board of Selectmen members, this board, town staff, for being awarded a AAA bond rating. Great job, hooray. We're very excited about that. We'll get updated information at the end. There was some savings to the town, so better than expected. Definitely worth mentioning twice. At the next Board of Selectmen meeting, the Board of Ed will be giving an update on the bleacher project on Simsbury High School. For anyone who's interested in attending, I know our colleagues follow that issue rather closely. As members know, earlier today I met with Lee Erdman and the Simsbury Volunteer Ambulance Association to discuss ambulance funding needs in anticipation of a recurring budgetary ask in fiscal year 2025. Lee will be conducting a rather intense analysis of the ambulance services provided, how those services are provided, and at what costs. He's looking for information that the Board of Finance would like to see, so that he can prepare that when they come to us for the funding request. I did have an opportunity to speak with all of you. I wrote out what I said, so you'll have a copy. And then if you guys have other things to add, of course, if you don't know tonight, you can email Amy or Lee at some point. I can give that to Wendy and Heather since you're here too, if you want it. So, Lee, is there anything you want to talk about the analysis, what's coming?
Thank you, Lisa. I would just briefly say that I think Lisa and I had a very positive meeting with Karen Stewart, the chief of the SVAA. She was very open to all of our suggestions in terms of what to look at. Briefly, we'll be looking at a comparison with other communities, the services they provide, how they provide those services, and the cost of providing those services. We're going to look at, I think, a very comprehensive list of options for how to provide these services going forward. We'll be looking at continuation as a private nonprofit entity. We'll look at privatization. We'll look at the ambulance service becoming a separate department of the town, or a division of the fire district, or a division of the police department. We're also going to look at the feasibility of perhaps a regional entity in conjunction with other towns. We're also going to look at the feasibility of setting up a tax district as our fire district is. And one additional thing we're going to look at that Karen suggested was the possibility of paying for these services as an add-on to your utility bill. That's something I don't know anything about, but we're going to delve into all of these options. We're going to look at a variety of performance information, a variety of financial information. And at the end of the report, we hope to have a series of recommendations, short-term, intermediate term, and long-term, with the idea of there's maybe some things we can do over the course of the next year, then perhaps the next couple of years, and then longer term, the next few years after that. So the idea is that hopefully after thorough analysis and discussion, and perhaps a multi-year discussion, we'll have an idea of what the end game is, where we want to be down the road, and then steps to get there along the way. So we're very excited about this. I think we can do this within a couple of months. Hopefully we'll have a report while I'm still here that we can share with the Board of Selectmen and the Board of Finance. And I'm hopeful that this will be important information for all of you as you go into the next budget process. I'm also hopeful that many of the issues that Lisa raised will be able to incorporate within the report. One of the things we're going to be doing is Amy's agreed to do a financial review. It'll be a basic financial review. It will not be a complete financial audit, but it'll be a basic review. We did learn today, that we didn't know this, that our Volunteer Ambulance Association has an annual financial audit done of their finances. Not required, they're not required to do that by any state or federal agency, but they do this as a matter of course. So Karen will be sharing the last 3 years of financial audits with Amy. She'll review those, and that'll be the basis for the beginning of her financial review. So we hope we'll have a good product at the end of the process, and we're hopeful it'll kind of set the stage for a good discussion going forward. Thank you.
Thank you. One of the things we also discussed is could the town support them through capital versus operating? So he's going to be analyzing that, and that might be a fruitful
Yes.
avenue to pursue.
Yeah.
All right. Lastly,
Quick
yeah,
question.
go ahead.
Lee, who does the audit? You referred to a federal or state agency. Is it a third-party independent audit?
Yes, it's a
Okay.
third-party auditor that comes in and does the annual audit. So we hope to review those 3 years of those past audits.
Great.
That's a good initiative on their part.
Thank you.
And I had discussed earlier with Lee the possibility of him or someone in his office doing a presentation on pensions to this board, and of course, Board of Selectmen, if they're interested. We're expecting a large turnover in the Board of Selectmen, 2 to 3 on the Board of Finance, a quarter of the Board of Education, just to level set on what are our pensions, how are they calculated, how much are we paying, and, terms to get, that sort of thing, just to level set, and our funding level. Sort of, for us, it'll be a little repetitive, but for new members, to talk about the funding plan, where we are, how we got there, and mostly the experience study. Those of us who have read the experience study, it'll be a recap of that. All right. So Amy, I think we are now ready to go to the finance director's report. I just wanted to let the public know that Amy did advise me that they had some unanticipated staff turnover, which prevented Amy from getting us 2 regular monthly reports in August and September, which of course is unfortunate, but was beyond her control. So in October, we'll actually have 2 reports. The first will be the quarterly report for October 2024, the year that we're in, but we'll also have the fiscal year 2023 closeout. And the fiscal year quarterly report will catch us up on our monthly reports, so we won't look back. And then from there on, we'll start the monthly and quarterly again. I had sent Amy the list that I think we're following, and is that okay? So we'll follow the plan that we had articulated earlier in the year, so that'll begin. So thank you for that. And Amy, why don't you get us started?
So the approved supplemental appropriations to date, we just have the one for the Cambridge crossing where we called the bond, and we did some erosion and sediment work for about $30,000. The grant applications and awards, obviously it's just the beginning of the year, so we have 2 grants that have been formally awarded and then 2 grants that are pending. Those will be going forth to the boards for the supplementals in October. The assessor's office performance audit, we did receive 2 bids that were submitted by the deadline of August 4th. We interviewed both firms. Lisa was able to join us for those interviews. The contractor has recently submitted a draft contract, which our legal counsel was able to review. And I believe we just did a turnaround contract the end of last week, the beginning of this week. So our contractor is currently in contact with our assessor and in the process of getting going on scheduling to begin the audit. We recently had our bond issuance. We're actually at the final stages of issuing those bonds. We should have money in the bank by mid next week. We issued $22,165,000. And as part of this, we need to have our credit rating evaluated. So as Lisa had mentioned earlier, S&P was our evaluator for our credit rating, and then we were able to obtain and keep our AAA bond rating. There's a communication in the communication section of the packet that gives S&P's formal report. The bond sale did take place on September 13th. We had 17 underwriting firms that bid. Typically, it's around 10 or so, but because of our strong credit rating and the amount of bonds that we're issuing.
I'm sorry, I missed that.
17 because of our strong credit rating and the dollar value of our issuance, we're able to get a lot of additional bidders. So typically around 10 is the norm. We did achieve 17, and it was awarded to Raymond James with an interest rate of 3.47%. So just a little bit of context, the week before that, Tolland had gone out and issued for bonds, and they achieved an interest rate of 3.55%, and they're AAA rated as well. So we did a little bit better. After the offering, we generated a premium of $970,000 after our fees. This premium was utilized to offset the par value of our issuance, therefore reducing our issuance. So not only does it save money on the amount of bonds that we're issuing, but it also saves on the interest costs. So the interest costs over the savings of the term of bond will be $801,755. So our total savings on this particular issuance was $1,771,755. So how does this translate to the budget? Fiscal year 24, we had budgeted about $7.8 million, and our debt projections based on the most current issuance have been updated to an anticipated $7.5 million. So a net savings of about $256,000 for fiscal year 24. Any questions on that?
Was Raymond James the lowest quote?
Yeah.
Not a question, but just an observation. I sat in on that phone call for the AAA bond rating, and you could tell that our team had done its homework. The flow was quite easy. There were no, I don't think I remember any, I'll get back to you on that, or could we just check our figures or see, or hesitance and so forth. It was a very fluid conversation. I see, Lee, you're nodding your head. I thought that the degree of confidence, and obviously doing the homework ahead of time, was noted by the people who were going to evaluate us. I say that as an outsider, just simply listening in on the conversation, but I thought that was a good performance.
Thank you. And then Lisa had wanted me to pull some data on our tax collections for July, given the large tax increase. So in July of fiscal year 23, our collection rate for July was 53.33%. We actually did a little bit better this July of fiscal year 24, it was 53.61%. And in talking with our tax collector, ironically, there were not many complaints on the real estate taxes. There were more complaints on the increase in the car taxes.
Fascinating.
Yeah.
And that's all I have for my report.
Right, thank you. I just wanted to give Lee mentioned to me a heads up that is likely coming to us at year-end close about using year-end savings potentially for a salary classification and total compensation study in anticipation of the upcoming budget season and 3 union negotiations. Is there anything you wanted to preview before you bring it to us?
Thank you, Lisa. I would just add that we've gotten estimates of the cost of this analysis from 2 firms that are in the business. So we think we'll be able to come in with a request of $75,000 to do what I expect will be a total compensation and classification study that is long overdue. In my opinion, we have job descriptions that some of which go back to 1989. We have an unaffiliated pay plan that is not very well aligned, certainly internally. Externally, we do a good job of keeping up with the market, but internally, there's a lot of misalignment, in my opinion. We have negotiations coming up this coming year with actually 4 units, the 3 CSEA units and the police unit. So we think the information that comes out of this total compensation study will be very helpful to us in setting up for those upcoming negotiations. So we do look forward to coming back to the Board of Selectmen and the Board of Finance to see if we can get the funding to move forward with that. Of course, we'll go through an RFP process and select a firm, and hopefully we can get such an analysis done within, I'm going to say 6 months, maybe less.
And for members of the public, just to, total compensation versus salary means you look at the whole compensation, health, pension, days off, vacation days, paid sick days off, the whole thing, because all of that has a value. And Simsbury in the past, I don't know, I haven't looked at it recently, offered slightly lower than median salaries because our benefits were quite lovely. And I don't know if that has changed, but that's why you can't look at one in isolation. But you have to look up what the market is posting for different jobs to get the range, but then you might offer medium or below the range because the benefits are so high, or the opposite of that if your benefits are not high.
Yep.
So that's why it's important, because it helps you right size.
Absolutely.
So I just wanted to give our board a preview, raise any concerns now if there are any before you bring it to us. Or if you think of something in the next week or two.
I don't have any concerns about the study, but could you say a little bit more about the misalignment you think we have in the job descriptions?
Yes, briefly, I would say that the history here in the town is to make market adjustments on individual positions within the unaffiliated class, so primarily our department heads. So those changes over time have resulted in differences in what the pay ranges are for different positions. So typically at the town level, there'll be bands of pay ranges. So at the top, there may be several department heads, like the police chief, the public works director, and one band, the same range. And then there'll be several ranges among the affiliated group. But because of the town's history of making individual adjustments from time to time, there's a great variability among what would otherwise be considered similar positions in terms of number of people supervised, responsibility, etc. So one thing the pay portion of the study would do is realign those positions within the unaffiliated group so that equal positions are treated equally.
So just some history there. Prior to this, Tom Cook, the Board of Personnel Subcommittee in the prior Board of Selectmen, said, hey, do a market range analysis anytime a position comes open, and let's see what the market offers this. Because if the market is offering a rate,
Right.
And we would do that for all unaffiliated at a time. So it was done through CCM and using other
Yes.
factors. So that
Yes.
was, and we had, the Board of Selectmen approved comparison towns with which we thought we were competing for employees with. So
Right.
that was regular part of the process.
Yeah, there certainly is a rationale for the changes that were made, but I think over time the internal equity has been skewed as a result of that, in my opinion. But again, a full study will either verify that or dispute that, and at the end of the process, we'll come back to the Board of Selectmen with a set of recommendations for making appropriate changes, if any, and what the cost of those changes
Or
would be.
savings,
Pardon?
or savings.
More savings, yeah.
Yeah, you're good luck peeling that money out of somebody's hand.
I will say Warren Buffett always does say, never approve a study like this because you only pay
Yeah,
more.
and-
But
Right.
that's why it's really important to do the total compensation.
Exactly.
And also, like a doctor who's supervising 12 people might be compensated more than a job that requires less schooling supervising
absolutely.
12B.
That's
So
all
it's
part
not
of it.
just,
Yep,
it's also the education background needed to do the.
yes, exactly.
Okay.
Is the study meant to help us negotiate with the unions or no?
Yes, it should provide good information to allow us to be ready for the upcoming negotiations and to target what changes we might want to see on the benefit side as well as the salary side.
So we did, if you'll recall, I don't know if anyone was not so long ago, I think I'm old, but we did a study long ago in 2014, I think, with Hooker and Holcomb, where we did a total compensation on pension and health, and we sort of looked at the contributions at that point. That became the basis for negotiation. It does, because we're respectful of our unions, things aren't done overnight, but everyone was informed of, okay, here's where the deficits are, here where we need to reach towards, and then over time, that served as the basis for negotiations over the subsequent 5 years. So similar to that, I hope.
Yeah, we're negotiating on behalf of Simsbury taxpayers, right?
Yeah.
Does the contract come with any ongoing consulting, kind of after the fact, or is it whatever the results are, they give us the report and they're done? It just seems like I don't know what the undertaking is, so 75,000, I can't really put any perspective around that. But you said you were going to go through an RFP process,
Yes.
so.
Yeah, so hopefully we can do better than that. Typically, this is a one-time study without any continuing role for the consultant.
Okay. Thanks, Lee.
So we will now go on to the draft policy for amending the budget, which was no small labor of love. Thank you to Amy Burt, who worked on this. We have Bob DiCrescenzo. Before the board is a draft on the updated policy on supplemental appropriations and transfers. And as background for the public, each summer, the board reviews a few policies on a rotational basis or on an as-needed basis. Transfers and supplementals have been some source of recent confusion, so we wanted to better clarify our policy in one document, because often the law on supplemental appropriations are in the charter, multiple sections of the state statutes, and education has separate stuff and library has separate stuff, so we were trying to capture it all in one document. As is our practice, we'll publicly review this tonight and then see if there's any further comment before approving or editing at our next meeting. The policy was a result, as I said, of a very collaborative process. Amy and I met in August with Bob DiCrescenzo, who has reviewed the policy. It was shared with Matt Curtis in August, but I did get a call yesterday saying that their council has not finished review, so there may be subsequent changes. We thought it was all done last week when I met with Amy, and then we got a call yesterday that it's still under their council review. I will say we used their council's literally education law book in writing this, so hopefully he likes it because his words are quoted fairly extensively in it. Our intent was not to change the current practices, but to better incorporate what the law and charter require directly into the policy document, and then to clean up some of our language and some of our motions. And when it comes time to the budget, you may see a slightly different budget motion, and we're working on that. The bottom line is we went with the general rule that all spending should be budgeted and appropriated when possible, unless specifically excluded by law. And there are a number of exclusions in the Connecticut state statutes, some of which we've included in our policy where we could find them. The other general rule we went with is that even if spending doesn't require an appropriation or budget, all spending should be reported through quarterly reports, which is why we see updates on trusts, which are excluded. And we had the opportunity to really dive into the comprehensive annual financial report and review every fund. So a couple will be added to Amy's quarterly report so that we're capturing all those. Most of the exceptions to the general rule do relate to education or the library, and those are complicated, and so over time, it may come up that, oh, library got something and it didn't need to come to us, and the question is, Why? Because it's an specific exclusion. So there will be a few of those especially, so I wanted to highlight that. And also, there are a few where state law does require a supplemental appropriation, but we have no discretion and we have to pass it. Those are mandatory passages. So that might seem odd to the public. So why does it come to us if we're required to approve it? And there's actually an important policy reason behind that, and that's for transparency and notice to the public. Also, tracking expenditures and revenues goes to public accountability, highlighting off-budget spending, and it is an important budgetary planning tool, and that's actually from GASB. GASB recommends all these things you want to highlight. So that's why you might do it even though it's a mandatory. And when it is mandatory, Amy will highlight that. We have a model how Avon does it, so you probably see that. An example of a non-discretionary approval that we must approve is when education gets extra money for open choice. They get that money, it's a new revenue, it's required to go to the Board of Ed, we're required to approve it. So it'll come to us for a supplemental appropriation, we can't say no. But we do it publicly so the public's on notice, and this board is on notice that there's another revenue stream coming into the town. All right, I do want to highlight two things in here that are different. One is the grants, donations, and what is the other one? Minor gifts and bequests. So we're still waiting on council opinion on this. This is sort of the outstanding, what do you do with gifts? And so we came up with this idea, which is what Oregon does. So we took from Oregon what they do. And we chose 20,000 because most gifts, donations, little piddly things that come in shouldn't really need to come to us. So if we make it our policy that those come in, if they're specific grants for a specific purpose, they can go ahead and spend it and we'll clean it up at year end. If it's a general grant, like it's just going to the general fund, then it does need to come for us. So the threshold would be 20,000. So give that some thought as you look at that. And then the other thing I would like board members to think about, because it is a change, is we have a level of legal control at the department level of budgets. So a department head cannot exceed their budget without coming to us. And the question is, what is a department? So one of the changes we made is Amy is now supervising taxation and assessment. So we included finance, taxation, and assessment as one board instead of each separately. One department instead of separately. So if anyone, Amy said she didn't have a preference, but those budgets rarely change, so we were just like, it made sense to keep it there. But if anyone wants to do that differently, that's something you should think about, because Amy didn't have a preference and I don't actually have a preference. So those are the two. So we'll leave that. Well, hopefully we'll hear from Matt and their attorney before then. And if anyone else has any other questions in the interim, of course, we're hoping to change it. This is a document that will probably change over time because it was hard to find the law on that. It required reviewing other states. We use ICMA budget books. As I said, the legal book that the Board of Education Council wrote, we use. So, and Connecticut law is really just all over the place, literally. So a lot of control Fs through the through the statutes. All right. So there's no action on that tonight. Are there any initial questions on that?
No, it's a big undertaking.
It's a big undertaking.
Thank you for all your work on this.
You're welcome.
Amen.
It was a group effort. I'm not going to take total. It was kind of interesting, right, Amy? I mean. All right. I'm not going to push that one. All right, let's move on to.
If it wasn't clear, I mean, this is a dense set of observations and regulations, and it doesn't actually change much or anything about whether we're going to spend money or whether it's going to be easier or harder to spend money. But what I do believe it will accomplish is make it much easier for anyone who's concerned about a particular expenditure to understand how it got made and what it was for. And also to prevent any second guessing about whether we violated the applicable rules for spending. So I think it's well worthwhile, and congratulations on it.
Thank you for your help.
Well said.
So the thing that's nice for Amy and I is when I go, Amy, why didn't they need an appropriation? She can point to this, well, this is the fund. And you go, oh, okay.
Yes, there's been a lot of back and forth that we can squash now.
And it's required multiple, but they were questions that required consultation because we could not answer it. And now we can answer them because council has okayed this, or at least ours has anyway. Okay.
He's right.
What?
No.
If you, all right, we'll just move on from that. Next, we'll go on to the budget preview. You've all had a chance to see this. I know you love me, and you can appreciate that it is a little dense. I get that. But we're going to just sort of go through it. There are some changes. Lee suggested a change to me in our budget process on the tri-board, so we may incorporate that if folks want. But just to do a quick preview, not set in stone. I wanted to start with the mill rate. This is sort of where we landed. And you can see that our mill rate came down.
I'm sorry, Lisa, you're rushing into this, but I think we should make it clear that what you're about to present is a summary of what we understand is how we can give guidance to the other boards about their budgeting, what we think about it, so that this process can be as well informed as possible between now and the adoption of the budget next spring, and in particular as the Board of Selectmen and the Board of Education work to prepare their budgets in a way that addresses some of the realities we're facing.
Yeah, and I'll just add, thank you, that was very nice. The other thing we found is that it has been frustrating for us to think about the budget without certain key information. So how can you think about the budget at different points in time? When you start out with very limited information, you get some information, then finally you reach the end. So we do this in a sort of progressive analysis. What information do we have when? What decisions or guidance can we give with the limited information we have? What can't we give? And then sort of go there. One of the questions we get asked an awful lot is, well, you changed your guidance? And the answer is no, the information changed. We give guidance on the information we have, because I don't think the public wants us giving guidance on information that we don't have that we're guessing on. So that's sort of the rationale behind it. But this is sort of where we ended up. At the end of last year, you'll see our mill rate came down 17%, but taxes went up. Median, because it was a reval, so not for everyone, about 518 for us, 975 for Farmington, Glastonbury 4.89. You'll see that Avon, Canton, and Cheshire, their mill rates are higher, and we go, oh, hooray, that's great. They're going through reval next year, so if they came down 17%, they would be in the 20s. So it's not a cause to celebrate. They may come down a lesser because the valuations, they're looking at a different valuation year. You'll see West Hartford does have a very high mill rate. They incorporated their assessments over a 2-year period. They did a reval smoothing, so that one's not as helpful a comparison because there was some wacky stuff going on there. And you'll see that Granby and South Windsor went through reval like us, and it was very different results. Granby, we thought that was odd, and we double-checked. Amy called their director of finance. They only had a 0.98% increase with a mill rate change that came down 20%. So we don't know exactly what happened there, but South Windsor was sort of in the mix with Glastonbury, Farmington, and Simsbury. Okay.
For those that reval, do we know what the median increase in property value was for the other towns?
No, I don't. I can tell you that the mill rate change was 17%, so kind of
Yeah.
similar, but no, I don't.
Oh, I see, yep. I see
Yeah.
what you're saying. Yep.
Okay. For the Board of Finance perspective, we generally ask the 5 big questions. What does it cost? What are we getting? What should we do with grand list growth or other revenue growth? Do we need to make hard choices? And are we protecting the long-term fiscal health of the town? Simple questions, very difficult, and detailed analysis. You look at inflationary increases. Are we getting good value? Are our costs and new programming exceeding an inflationary increase? If yes, why? What can we do about it? If we have extra grand list growth, we can use it to offset our fixed costs or new programming, to reduce taxes. We can use it for capital, we can put in reserves, retirement funds, or other. And then if we need to make hard cuts, there's zero-based budgeting, cost-benefit analysis, prioritization, efficiencies. Those are mostly done by Lee and Matt, because those involve some difficult and hard choices in their boards. Spend to save are often done by us, like when we did the streetlights, we invested in streetlights and that saved on operating budgets. The use of reserves is often a decision by the Board of Finance, and to reduce capital and borrowing is often a Board of Finance tool that we use. In terms of long-term fiscal health, that would be fiscal policies, best practices, and economic competitiveness. I added that. Is our mill rate competitive with our comparison towns? Okay. Those questions are then informed by several broad categories. The political environment, which includes citizen feedback and citizen involvement, Board of Selectmen and Board of Education priorities, which obviously at the beginning of the process have not been done, and strategic plans. The economic environment, we look at factors like we heard tonight from Fiducian, recessions and expansions, inflation and changes in interest rates, competition for business investment and residents and mill rates. The social environment, we'll look at population and student enrollment changes, age distribution, personal income and unemployment, and of course the legal environment. Any state mandates, we are legally required to put a balanced budget before the voters. Debt service obligations, which we are legally obligated to pay, and negotiated settlements, again, we are legally obligated to pay, although you don't, as Linda, if she was here, you don't have to have the same number of employees, but for those you have to pay them. We have a challenging information timeline. In August, when I wrote this, the CPI was 3.2%. I think it's now at 3.7. In September, the Board of Selectmen and Board of Education will have some estimates and projections from Amy, but not fixed costs. And tonight we'll do a municipal cap estimate. So we'll do that. In October, OPM releases its schedule of motor vehicle values. So we'll have our first trend look. What are we seeing? What do we think's coming? We'll have the Social Security COLA is announced, which is a key inflation indicator and affordability measure that this board uses. In December, we'll have an updated CPI. What was the 2023? Right now it's at 3.7. It may or may not come down to 3.53. So the two big indicators we look at are COLA and CPI. One of the things we have done in the past, sometimes we have done and this is a question for our board, a tri-board in December. And Lee had suggested we consider doing a tri-board before we do the evaluation of CPI and COLA. Just do a general, what are your priorities? What are you thinking? Here's the budget process. So we could add a tri-board in December after everyone's sworn in and before our regular December meeting, something to think about. And then at the December meeting, we do our first look at inflationary increases that we can consider. In January, Amy had said she may be able to guess us the fixed cost estimates as soon as November or December. Last year they came in January, so hopefully we can get those earlier. The earlier we get them, the better information we'll have to make decisions. We'll start to get the economic condition mill rate estimates from comparison towns, and we do rely on Wendy to go to the Farmington Valley Collaborative and report those out. So mostly we get those from Wendy. January 31st, we start to get the assessor to publish the grand list. I know that got delayed last year, so I know one of Amy's goals was to get that done on time, so I think that will happen, but we have really good estimates now. I think Francine did a terrific job, so our estimates are tighter, so that's going to become less important because of the work that our assessor and Amy have done to get the estimates better. Then in the third week, in the third week of February, we start to get the governor's budget, and that's when we have all our revenue information. We were thinking of doing the tri-board formal guidance right after we get the grand list, because then we'll have the key information. governor's budget revenues don't change that much. Usually there's a $300,000 to $500,000 shift, but nothing dramatic. We won't have that, but that's probably sufficient to give a really good guidance in the first week of February, so that will be the second tri-board. And then we start getting to budget presentations, budget approvals, and the hearing. So just to think about, we'll get, at the end, we'll talk about whether to do something in December for first tri-board. Here we did a flow sheet, and really after the meeting, I expect a lot of high fives, because that was very difficult for me to do, but we didn't get that up. But you'll see on the left, we start out with estimates and projections, which we're going to start out with tonight, which is the first look. As time progresses through December, we can start to get some target information on inflation. And then at the end, we'll have actuals when we actually approve a budget that goes to referendum. So the first question we'll ask tonight, are taxes going to be flat? If they are, hooray, low scrutiny from our board. That has been our board's policy. We give less scrutiny when that happens. We know that they're not. So then the question we'll be asking is, what tax increase is reasonable to put before the taxpayers? And to do that analysis, we generally look at affordability and willingness to pay, inflation indicators, Social Security cost of living adjustment, fixed costs and needs, what does the town need, municipal cap, which we learned a lot about last year because we almost exceeded it, and economic, social, and political condition, which are those factors that we talked about. Finally, once we get the grand list, we can start talking about, okay, did grand lists come better than expected or not? They generally come in about 0.5% better than we think it's going to come in. Some years 1% better, 1 year 1.5% better. But once we know that, we can say, okay, can we use that extra grand list growth to come in with a tax increase that's lower than what we were hoping, that we had found acceptable in December? Should we use it for cash for capital because we have a lot of capital needs? Are other reserves deficient that need support? Those are generally retirement or health. Or do we use it towards operating increases, fixed costs, and new initiatives? And so at that point, we'll really have an idea of where we are. In terms of inflationary indicators, I did ask Derek to take a close look on the construction. But generally, this board has looked at the Social Security cost of living adjustment, the Consumer Price Index, the Connecticut municipal cap, which is 2.5%, or the rate of inflation. And we also look at the 2.5% inflation long-term inflation assumption rate used by our actuary that we just did through our experience study. There are other indexes like the producer price index, the construction price index, the employment cost index, the personal consumption expenditure index. There's the municipal cost index, which I think you have to pay to get. So I don't know if we belong to that or not and can get that, and I don't know how useful that is. But these are some of the things we all look at our own. When we discuss publicly, we generally focus on the top four. But
It says right in the MCI definition that municipal cost index is a composite of CPI,
Yes.
PPI, and
Yes.
the construction price index.
it is.
So
We could do it on our own,
Yeah.
yes. Which is why I just put it there. Is it worth paying for? I don't know, because we already have the other things. Then for the social and economic condition, this was presented by Lee as to what he thought we should look at, and that includes Simsbury mill rate with comparison towns. The ALICE percent, which is asset limited, income constrained employed, so the working poor. Median household income, percent poverty, median home value, unemployment, population and enrollment trends, and other. I added commercial vacancy rate because someone who had been a former finance board member recommended that, Mike Long, because that can give a sort of a headwind as to how our business economy is doing, so we asked for that. Okay. So what might December, I don't know, guidance is probably too strong a word. Evaluation?
Use guidance.
Guidance, right? If we go with the conception that guidance will change, and people understand that guidance has changed. Once we have more information, we can do our initial guidance or our initial evaluation, whatever word isn't scary. It would be tax increase no greater than, and that would be based, we won't have the needs yet, right? But that, or the fixed costs, but we will have the inflation indicators. So we will be able to say this. It might be debt service budget, we will have that known, that at that point it will be known. And then the Board of Selectmen budget and the Board of Education, we can then work backwards into, okay, if we do that, based on what we know today, here's your budget numbers. We would give guidance, and I think these we've already approved. General reserves, no less than 15.5%. Debt service targeted at 7, not to exceed 8. Pension investment assumption 6.5. Fully fund the ARC. Tax collection assumption rate 98.5, and health reserves 20 to 25%. Those are generally hard guidance. Those will not change, and we will not exceed those. So we'll clarify that in December. Use of reserves. At that point, we will have year-end close, so we'll know how many reserves. We might say, hey, don't deplete reserves to 0. Make sure you leave at least $1 million or $500,000, or depending on what our long-term needs are. We may give guidance on that, and we may not. We have asked for prioritized CNR and capital for potential reductions, and Lee has committed to doing that, so thank you. Health reserves, our policy is to use no more than a third excess health reserves to reduce costs, and that will likely remain the same. Then the guidance would then be adjusted at the tri-board February after the governor's budget. And it could be changed then during budget deliberations as we get more information. So that's how it sort of changes over time. But these are the key guidance things that I think we need to convey to the boards. Not that hard to put on paper, very hard to execute judgment on. All right? So what we did using Amy's, again, this was done in August with the August numbers, so not updated. Well, what is the first look? If we start out where we are today, with nothing changed, just on what Amy gave us, we're at 4.18% netting out ARPA. You'll see I took out ARPA as an expenditure and ARPA as a revenue to get the true expenditures. And so what would we need to do to get that down? Sometimes nothing. Maybe the grand list will come in really high. When we start out with this number, that does not incorporate vacancy savings from people who've retired. So as those numbers get truer, that will normally come down. As you'll recall, that came down about 800,000 to almost $1 million last year once they incorporated the vacancies. Borrowing cost and bond premium will come down, and we saw tonight that has come down. So we've already started to reduce that. But from there, you can sort of see what it looks like. Okay, if we're at 418, the tax increase, and I just did the medium home at 400, is a 372 tax increase. There was a time in the world where that would be alarming. Where our tax increases when we hit 35 was alarming. 372 that will be very helpful with the new elected Board of Selectmen, Board of Finance, and Board of Education members to get an idea of where they are in terms of comfort with tax increases. I know door knocking. I'm hearing something different than Amy or the tax when you go to the doors. I've had a few people cry, but that may not be representative. So that's why public input and communication is so important.
But you're saying that based on what we're seeing now with no changes, the median household will have a tax increase of $372 following on last year's
Yes.
tax increase, which the median was larger than that.
It was
anyway.
larger than that, yeah.
So
So it's additive. So our board has
it's a real burden.
Yes, our board last year expressed concern about the
Yes,
next few
we did.
boards. And a lot of that is driven by debt service. And Lee and I had that conversation. Can we use some of our capital reserves and with Amy to smooth in some of the debt service because there are going to be 2 years of peak. So those are the things. I mean, it will be probably under 4 once some of the adjusted, but we'll have to see where we go. So then we keep going. So I did a 5-year history. Well, where do we end up? Remarkably, we are always under CPI and COLA. And you can sort of see that even though we had And I broke it down by gross budgets. So total spending. And then you can sort of see where the budget increase was, 5.8, 8.4, 3, 4, 1, 1. Gross budget is a little off because some of those were funded by grants. So it's a little misleading, not misleading, but a little less true. And then you get to, well, what about the grand levy? That's the amount you have to raise by taxes. So that's sort of the true impact of what drives the taxes. So you can sort of see how that changed over time. And the grand levy increase was 644, 239, 376, 144, 406. But the tax increases were 518, 0.91, minus 62, and 247. How is that possible? Grand list. Grand list is the offset. So it's really a driver. And you'll see in the past few years, our grand list has been very good. We are anticipating.
Some of that is ARPA as well, isn't it?
No, because the ARPA is netted out. It's the grand list, so it's not. The grand levy is the amount to be raised by taxes, so it excludes that.
Okay.
But the projections for grand list going forward are very, very weak, 0.74 for the next year. So that we will not have that levy of the grand list to come in and save us, we think. But you'll see that we've been under. CPI was 5.8, we came in at 5.18. COLA was 8.7, we came in at 5.18. And so we did well, except for 1 year in 2019 when we were a little over the CPI, but still beneath the COLA. So for anyone watching from the boards, the guidance is probably going to be coming under COLA and CPI at some level. All right. This is the grand list projections we were talking about. You can see 0.74, 0.5, 0.69, 0.68, dramatic difference from the 3 and 2.5. Okay. What does this mean? We go into debt service. We're now about to hit. We knew this was coming. We've been planning for it. But you're going to start to see a big increase in debt service, 11%, 15.23%, and then we get a little reprieve, then it goes up again, and then a little reprieve. So it's really the next 2 years that are going to be very, very difficult as the debt service increases. That's going to put significant pressure on the other departments in town and every department in town, okay? Here you can sort of see it as a graph, the bubbles. Almost $1 million next year, although it's going to be less because Amy did a great job and we did a great job with our AAA bond rating, so that's already better, and the other numbers will get better, but these are going to be the challenges, all right?
This is a good chart. I like this one.
That one?
This one, yeah, I like the way it illustrates the prior chart.
Okay, thank you. This is a deeper dive. We're not going to go into it, but basically what it says is we're meeting our policy 6, 7 debt service projections. You'll see they're still under 8, but they're a little higher than we want. Debt service as a percent of the property tax revenue, if you could just skip down to the bottom, you'll see that's a little higher than we want. So when you do the deeper dive, we got to work on capital. We got to prioritize capital and get capital down. That's the story that tells. If we can't control our operating budgets. These you can read on your leisure. I just threw out things people have said before. I added Lee's compensation analysis there. The vacancy rate we had talked about. In the POCD, they were requesting a fiscal impact tool for new development. We're really good at projecting revenues that are coming in for new development, not great at projecting what the costs that are associated with it. So that would help with that. We'd asked Amy, and our advisors have indicated they can get us earlier numbers on the health contribution and pension, so we do anticipate that happening. And then our perennial disclosure of foregone revenue from tax concessions, fees, and exemptions. So basically abatements, those should be in the budget as foregone revenue. This is revenue that could have been used for desired programming, okay? And then we keep type of questions that the Board of Finance typically asks. We are a really boring board, and the questions we ask are actually really consistent. And you can see these are the ones we put together last year. And they mostly go to revenues, expenditures, risk efficiencies, funding sources, and performance measures. One of our jobs is public accountability, and to do that, you need to measure, are we getting what we were promised? And to do that, you need performance measurements. So I know Lee has made that a priority, and we do anticipate we'll see the beginning of that. It probably won't be complete because you have a lot on on your plate, but it is a start and something we will be working towards over the next few years. And you can read those later or add to them. This is just a notice. In terms of tools that we have to reduce budgets, we generally have capital reserves for CNR and CIP that we have been saving for. We can reduce debt service, pay off existing debt early, use cash instead of borrowing for future projects, which will reduce debt service in the out years, which is what we did in this last budget cycle. We can reduce capital projects. We had talked at the last budget the need to probably reduce $4 million in capital projects in that fiscal year CIP. We can reduce health costs by using 1/3 excess reserves if reserves are sufficient, and we'll have a first look at year-end close as to where those are. And then there are cuts, which are zero-based budgeting reductions, and these are mostly done by the Board of Selectmen and the Board of Ed, because you know, hopefully are prioritizing your services. It can't just be additive, oh, I have a good idea, I want to do this. If this is a priority, something else generally needs to fall off, because there are always more needs than there are revenues to meet those needs for any town in America. This is not unique to Simsbury. And I know Lee has indicated he's going to start the process of zero-based budgeting, which we were very pleased and happy to hear about that.
Prioritization got the last bullet, huh? That I was
Good
appreciating.
move to the
I
top.
appreciated it being on there, but not to the top. I'm thinking second.
Absolutely. Well, we already had a commitment that it's going to happen, so I'm putting it in as a foregone conclusion. There will be great sadness if that isn't there. In terms of some of the resources we use that we look at is the Connecticut Town profile, some of the numbers where we get it, the OPM Municipal Fiscal Indicators, the Simsbury Equity Profile, Partnership for Strong Communities, their housing profile. Department of Education has a number of sites that you can evaluate and see how they're doing performance-wise. We look at the U.S. Census and the head median fair rent. So people say, how are you coming up with what's a reasonable tax increase? We look at that stuff. We also look at strategic plans. We'll ask Lee to review those and see if there's any we've missed. So we do look at, we are aware of the strategic plans. We do look at them. Some of them we have not had the opportunity to review. We haven't seen the town facilities master plan. The school facilities master plan was shared, but it's not online. And we have not seen the police study. So would like to see those if those are going to entail funding requests. Best practices of municipal taxing. Purpose tax for public purposes only. So in other words, the town cannot give donations. We're not a foundation. It has to be given for a public purpose. Stability, use one-time revenues for one-time expenses, not for recurring operating costs. Adhere to town policies. Fairness, use broad tax bases with low rates, minimizing exemptions. Perennial plea of this board. No taxpayer or group of taxpayers is favored over another without good cause, and sometimes there is good cause, like veterans, elderly, disabled, firefighters. Avoid tax favors that skew market decisions without good cause. So limited to but-for tax abatements. If they were going to come anyway, you don't need an abatement. An abatement is to encourage development that wouldn't come but for the abatement. Fairness, use revenues to reflect costs. Fairness, fees appropriate when charged for a particular service that benefits the party paying the fee in a manner that's not shared by other members of society. Paid by choice, not to raise revenues per se, but to compensate the entity for its expenses. Where spillovers are minimal, in other words, non-taxpayers do not benefit in some way from the fee payers, and when the ability to pay does not create a disparate impact. Sometimes a fee can dissuade people that we want to get involved in the community from participating, and that would be a reason to do away with that, and as we did in the library when we got rid of the fees. Transparency, make taxes transparent and visible. Link taxes to outcomes, benchmarks, and performance indicators. That's a GASB, GFOA, ICMA recommendation, and very pleased that Lee is initiating that. efficiency, strive for simplicity in administration of programs and services. And these are just general, broad concepts. I did pull this, and I probably should have put this higher up because I thought it was interesting. Well, what do other states look at to determine are taxes reasonable? Well, Connecticut has said, hey, municipal cap 2.5% tax increase or the rate of inflation, and they exclude, with some exclusion, debt service, costs associated with major disaster, motor vehicle grant reimbursement, stuff like that. Montana looks at a 3-year rate of inflation and then says you can do half of that. So that was interesting. All of them have exclusions, and they incorporate grand lists in various capacities, but it's sort of a good guide. Washington State does 1% plus new grand list from construction. Massachusetts has Proposition 2.5 plus new grand list, allows overrides if they're articulated why. And New York 2%, lower of 2% or the rate of inflation, again with an override, but they require 60% of the voters. It needs to pass with 60% for that to be given. That's sort of a nice indicator as to how we could think about it and why we think about it that way. All of them are really detailed. One of the things I asked Amy in our modeling is to add the Excel spreadsheet for the municipal cap. So we'll have to take a first look at that, all right? And then we look at our mill rates. You can see where those are. I used the median home value in 2021 because that's what OPM municipal fiscal indicators had, and I did not have time to look up each one individually. But it still gives you an idea of where we are in the mill rate. Remember, Avon is 35.39. Oh, we're doing better than Avon. Oops, they're going through eval next year. That's going to drop a lot next year. So what this tells us is we're below West Hartford, we're below Granby, but other than that, we're on the high end. Is it ridiculously high? Does it need to change our thinking? I don't know, but it's something we want to think about. We worked for many years to get us in the mid-range, and now we're creeping back up to the high end. So it's something we're watching. Okay, is that it? Or is there more? Yay, all right. So Amy, if you can bring up your modeling, and we'll go through the modeling. Take a look at where we are. And did you take out the CNR cash payment?
No.
Can you take that out? Because we're not going to be able to do that. And Amy, can you highlight the fiscal year 2025 just so we can get that column? Okay. So that's sort of where we are, and given her numbers, that brings us into where on the taxes? 528. You can. So
for a $350,000 home, it'd be about $413.
Our medium home now is 400 though, right? So where is the 450, or do you have the 400? We may need to change our categories to 400, 500, and 600.
It'll be halfway in between the two.
Yeah. So too high, probably. So we say, okay, 432. Let's just pick a number. I'm hearing anywhere. I don't know what COLA is going to be. Initial projections were 3. CPI came in at 3.7. So if we want to get to 3.5%, how much would we need to cut for a tax increase?
You mean to avoid a tax increase?
No, to get the tax increase down to 3.5% from 4 1/3. If we want to get it to 2.5, there's a lot of cutting that needs to happen.
So to get it to like 2.4, that
3.3 is good enough. I mean, it's close. It's in the 1.5 to 2 million to get it within the CPI. If you want to get it to the 2.5 mark, that gets harder to do. So how do you get there? Well, again, it means prioritizing the operating budgets. It may mean the grand list comes in and saves us.
Highly doubtful, but, or
So
highly hopeful.
So one of the things I did ask Amy to model was the municipal cap. Where are we with the municipal cap? I forgot what number I gave you. Did I give you 3.2 or?
Yes, you gave me 3.2.
Okay, so if it was 3.2 at the time,
So it's at 3.2. We're at 4.07, so we're still too high. Where is?
but the municipal cap has some exclusions like
It
debt.
does, it has special education, debt.
Right.
Though.
Did we add the Excel spreadsheet as a tab? Okay.
I don't know why it's not coming up. Something happened to the file. I can add it back in and resend it. I think I have the one from last year that we can use as a guide.
I mean, just, I did talk with Lee, and most towns do not exceed the cap unless there's a really compelling reason that something extraordinary has happened. So that will generally be a good guideline. You know, it's just not gonna happen unless there's something. And if there is something, we're gonna want a lot of details on it.
So this is essentially what we added, or what I added to the spreadsheet, or thought I added to the spreadsheet. So you take the original budget, you can get rid of debt service, you can get rid of your special education expenditures, any non-recurring grants, capital expenditures, and then payments on pensions to get down to your number for comparable from year-to-year budget. So I'll have to update that again.
And what percent increase is that? Is that compliance with the cap or no?
So we did fiscal year 25. Special education will keep the same. ARPA's going away, that's gonna be the same, and that's probably gonna be the same, we don't have any estimates on that. So that minus that. So it'd be 2.48, and then you gave me 3.2.
I'm sorry, what?
It would be 2.48 increase, and then you had given me 3.2 to compare to.
So we would be within the cap.
Well within the cap.
So that's another thing we'll look at, and that's given where we are at what tax increase, 3.5? At the 3.5, so that does get us within the cap. So one of the discretionary things we'll have to decide, and that will be dependent on what the needs are. So how can you decide whether that's realistic to put before the voters? One of the questions we always have, do you say, what's my budget, live within the budget? Or do you say, what are the needs? What are we gonna tax to meet those needs? And the difference between town and a business is there's no profit. It is literally just paying the needs. But then it goes to compensation. Are we over, compensating? Are we fairly compensating? Are we undercompensating? Those questions then start getting asked. Are there alternate funding mechanisms? Can we do a public-private partnership? Can we do regionalization? How can we get that's when you start to get into the more detailed questions that we get into. So you can see, might be within the cap, still might be too much money for the taxpayer, to put to the taxpayer. Might be within the cap, yeah, we can put that to the taxpayer. Those are the judgment calls we're gonna have to make, and the answer may depend on why? What are you spending? What purpose, is this a good thing that we can say to the taxpayers, yeah, they want the extra whatever. Hopefully, Lee's gonna work in there, if he has something he needs, he's gonna find something he can do without. And swap things out and prioritize, but that's sort of a first look.
It'll probably largely be the exceptions that push it beyond, right?
I'm sorry?
It would most likely be the exceptions from the cap that will push it beyond the cap.
Could be.
Yeah.
Yeah. But that doesn't change the tax increase, so that's where it gets concerned. You still have to the municipal cap is a leeway, but it still might be too much, and what's driving it, you're right, is one of the exceptions is debt service. And that's gonna be hard. Some people saw $2,000 a year increase in taxes. It's gonna be hard to ask them to come in with another 400 this year. Maybe, or maybe the public will come in and yay, we wanna spend, I don't know.
We need the public to come in first.
We need the public to come in and let us know. We do need to know. But though that, people say, well, can't the Board of Finance just be formulaic and it's always this? No. It always involves some judgment, but here are the factors we look at as we exercise that judgment. And it includes public impact, public feedback, and we value that and we hope it happens. It includes board feedback, we value that and hope it happens. It includes staff feedback, we value it and hope it happens. But at the end of the day, there's only 6 votes. And but what we're trying to do, I think Bert said it better than me, is articulate, well, how do we do it? It's not just what we feel. It's based on data and analysis that we look at and that we see and that is reliable. So that's sort of the initial thinking there. What are folks' thought on doing an early tri-board in December, right after the election, just to get, no pressure, just, what are you thinking?
I think it's a good idea. I think, the
I like that last
the numbers are still scary. So when we talk about our considerations, a lot of the initiative has to come from the other boards. And I hope the public will make their voices heard early in the process, but I want to express or repeat what we said last year, except with more emphasis, is we're asking a lot from the taxpayers. We asked a lot from them last year, and this year we hope to ask less.
Right. So if it seems like that's a consensus, Lee, thank you for the suggestion. We'll go ahead and do 2 meetings in December, 1 tri-board, just to get feedback. It'll be helpful to understand where the newly elected members, how they feel about taxes, whether they're...
Nobody likes taxes.
Well, but people may have things they want to spend on that they're willing to tax for. So it'd be a good idea to sort of get a feel, and also to get the 3 boards, to Bert's point, to do a first look again. Here's where we are. Here's what it might mean.
It is guidance.
It may be in compliance with the municipal cap, it may not at that point, as the numbers change when we look in December. It may be under CPI and COLA, or it may not. So we'll at that point, we'll have much better information, because so we can do a first look. And
But the point about this process is that, the outlook changes as more information comes in. But if the information comes in bad late in the process, it's much harder to adjust to it and make changes for it. So we need to start early with severe assumptions so that we're ready for what happens.
But the tri-board is the only way to convey that?
No.
I just,
what's your thinking?
getting 40, 50, 60, folks together in one room is a big ask, right? There's a lot of folks that are going to want to have say in those meetings. I'm sorry, I'm actually not a giant fan of that process in general.
That is fair. I mean,
You know, I've been through a couple of them now, and I don't know, I don't see the benefit from it.
Well, point well taken, but one of the benefits is to share the burden. I mean, if we do come up with, and it's initial, and it is guidance, I mean, one of the benefits there is that those who are going to be looking at the expenditures realize what that burden is going to be. I mean, I hope that comes out of the tri-board meeting, which is also part of the sharing the pain.
Sure, but again, I'd like to think in 2023, heading into 2024, that it doesn't require a meeting of, 60 to 50, 40, 50, 60 people in a room to execute that. That we can't convey that in a different way.
so we could, but you lose the interactive dialogue, which I think Lee was looking to promote. And I do appreciate that. Lee has been great in reaching out to stakeholders as he reached out to this board on the Farmington Valley ambulance stuff. And so it's a way to do that. The other thing where it might be beneficial more this year than in the past, Mike, is the Board of Selectmen is going to have 4 new board members. This board might have 2 to 3 new members, half to a third. Board of Ed is going to have a quarter new members. So not everyone is going to be familiar with actually the budget process.
That's fair.
So just explaining the process and the methodology, they're going to be like, well, why doesn't the Board of Finance just give us guidance? It's like, well, we don't have the information. Here's when we get the information. Here's what we're going to be looking at, and it's going to change over time. And we hope to work with you collaboratively. Hopefully you'll look at this data and say, uh-oh, we need to find savings in the budget this year. This isn't, let's increase new programs or staffing year.
And that latter point is the one I was trying to get at, that if you have that briefing, then when something comes up in the year, in the back of your mind is, we were already looking at a difficult revenue situation, and that's in mind when you decide to do that project.
Yeah, or you're looking right now, I'm sure you're looking at staffing, open positions. Do I need this position right now? Or would I rather put that towards, we have a social worker with no funding? Should it go to that? Those kind of decisions can start to be made during the regular process. I mean, so I understand what you're saying. They are always less fulfilling than I hope. One of the things we can do, last time I did meet with Wendy and Susan Selena, we tried to plan it out as best we could, but as you say, with a lot of people with a lot of strong opinions,
right.
it can turn it a little bit into a free fall.
That's a
Feels
fair
like it just gets pulled sideways,
Yeah.
and it, why are we there, right? And it just
So-
becomes this,
This one may
This-
be,
the
Yeah.
tri-board, yeah.
yeah.
A lot of opinions come out.
Yeah,
Yeah,
and that's great, right? I love the passion.
No,
It just, what are we there to do?
So I think at
What's
this,
the goal of the meeting?
I
If
think
it's
it's to
for everybody
preview,
to,
get on this, see the same information. This is the information we have right now. This is the information we don't have.
right,
This is what we know right now, and this is how our board's judgment may change over time as we get into it, and how their judgment may change over time as they get information. Wendy, was there something you wanted to add?
Make a comment, and I think Heather had a question if we're allowed. So the tri-board, the initial tri-board, in my view, if we do have something in December after there's new elected people, it should be geared more to the process and not just like totally go crazy over the numbers because they're gonna change. And if we could all be new people on that board and just coming into this process from historically, having to do it, your first year, you don't really know what you're doing. And you learn as you go along. And it's, for us, I think it's, we get so much information all at once. It's like drinking through the fire hose. If it can slowly be shared with us, starting from December and then maybe re-meeting in January when there's actual numbers or more information. So that would just be my thinking on that. But people don't really, if you're new and you're going to that tri-board meeting, I don't remember knowing anything about what was going on my first year.
No, that's a good suggestion, and really we can work with Amy and Lee to start with the process. What does the budget process look like? And we'll refine this. What does the Board of Finance analysis process look like? And get everyone's, to the extent there are known issues out there, let's put them on the table. One of them is how are we going to fund the ambulance if we're going to fund it? That's going to be a big one. Yeah.
Not to put
Well,
nothing to
we
find out.
we had a pretty good. I'll fill you
Yeah,
in.
very good
It can probably be met a lot with capital, so that will help a little bit.
You know,
Yeah.
the Board of Selectmen always seems to be not necessarily active, but participants in our meeting. That's two of the three boards. So Wendy's bringing back a lot of valuable information and summary of discussions that we have here at the Board of Finance to her board. So I would say she's probably pretty on top of what we're actively talking about on almost a meeting-to-meeting basis.
Yes.
So I might suggest that somebody from the Board of Ed maybe show up once every other month, once every 3 months. It might make it a lot easier for those tri-board meetings to be more productive.
We have absolutely offered a liaison. That has not been something they've been interested in doing, but Amy is the representative to the Board of Ed and can report out on, Amy is unfortunately the most difficult job in the world because she has to be an independent advisor to us, give us independent analysis. She has to be an independent advisor to the town.
I'm certainly not suggesting
Yeah.
that Amy put any more on her plate right now.
Yeah. But you can give a heads up. I mean, I do talk with Matt periodically, like Matt came down when I met with Amy to preview this, because he had heard about it, and I think from me, that we were gonna talk about the budget, but it might have been from Amy. But he does come down periodically, and Lee is very open, and I encourage anyone to reach out to Lee directly as well. Has been a great source of information and very open and willing to share information as he gets it. So that's really helpful to our board. And Amy, of course, great work as always. We're grateful for
Lisa,
that.
in that regard, if I could mention two things that will probably impact the process. The first is, as I think you know, we have moved up the date for the development of the capital budget and the CNF. Departments are in the process right now of preparing their requests. We've expanded the capital budget to look out 12 years instead of 6 years, which is going to be a lot more work for the departments. Will probably not be perfect, you know.
Okay.
And we've actually added a 13th year, a 13th column for departments and the Board of Education to identify projects that they think will come up or they'd like to have come up within years 13 to 20. So we'll actually have a 20-year forecast for capital needs. We're staying with a 6-year CNF this year and hope to go to a 12-year the following year. And we will probably have preliminary capital budgets and CNF budgets in November.
Oh, that's great.
And we would like to bring those to the Board of Selectmen and the Board of Finance to get your initial reactions to those. We are going to do our best to have both of those schedules completely prioritized. One of the things we're doing is we've created an internal capital improvements advisory committee. So we have half a dozen department heads who have reviewed and refined a set of criteria to judge priorities both within departments and among departments. So please think about what you would like, how you would like to react to those preliminary plans. The second thing is there will be a new town manager. Sometime in this process, the Board of Selectmen has reduced the field down to a single candidate. And that candidate, the finalist, will be available to meet the public next Tuesday night, the 26th, from 6 p.m. to 7:30 p.m. at the main firehouse in the training room. We hope we put an announcement out on social media, so we hope there's lots of people that show up. There's not a lot of parking there, so we've suggested some alternative places for people to park. The Board of Selectmen has specifically asked for feedback from the department heads. The department heads will be meeting this candidate on Tuesday afternoon. Then feedback from the public reception, so that they have views from not only themselves and our consultant, but also views from the department heads and the public before they make a final decision on whether or not to make an offer, and then hopefully negotiate a contract and bring someone on board. So that will undoubtedly impact the process in ways maybe we can't anticipate at this point, but hopefully it'll all be for the good.
Yeah, Lee, the only thing I'll add to that is I'm really glad you're prioritizing capital, because if the Board of Selectmen and Board of Ed come in with a huge or a greater than anticipated operating budget increase, to get to the tax level that we're targeting, it may require us to use some of those dollars to
Right.
reduce existing capital. So we will fund as much capital as we can. I was telling Lee, once we have prioritized capital, we can use year-end savings to prepay some of the stuff off.
Right.
Right now, we don't have that, so we're not gonna do one-off considerations. But once you have that, we'll fund as much as we can, show us your priorities, and we'll fund up to that amount, funding your top priorities. But if every time we do that, we have to go back and look at 25 projects and do the reprioritization, I mean, that's just not a feasible structure. So that will help with that too.
Yes, absolutely. And the second reason that I'll be presenting these plans as preliminary is I think it's important to allow the new town manager to review that preliminary plan and then do some fine tuning in conjunction with the operating budget. There may actually be an opportunity, if you want to consider this, to use the first tri-board, tri-town, maybe someday we'll merge a couple of.
Not more people.
So, for the tri-board,
In December, you
use
mean?
that first meeting in December to have a dialogue around the capital and the CNF specifically.
Yeah, I think that makes great sense, with the caveat that, looking at one, just like looking at salary in isolation of
Yeah,
pension and
exactly.
health, it
Yeah.
doesn't tell the story, so it will depend
Right.
on what these other things are.
Of course.
It's the total package. Yeah, Heather?
Hi. So you had mentioned earlier that when the mill rate got quite high, that you worked to get it back into the mid-range, and I was just kind of curious at that time what sort of strategies and things that you looked at and, kind of worked at to get that back more.
So there was, I would say, tri-board consensus that we needed to do that. We were seeing that our economic development wasn't growing. So everyone was rowing in the same boat. If everyone's not rowing in the same boat, it's very hard to do. But those are very, very lean years. There was no added staff, no added programming. We did a lot of initiatives at that point, like Spend to Save. We did the street lights used a capital investment that was easier to afford, that led to operating savings. There was just an intense relationship. We used to do every summer. We weren't able to do it this year because of the transition. The tri-boards would come in and we would talk about savings initiatives. We, as you know, we asked to see what savings initiatives were in the budgets last year and didn't get that. But there was a huge commitment to doing that, and it was done every summer. We hope to get back to that with the new.
I would love to get back to that.
Yeah, and talk about what ways we can do it and what were we exploring. And a couple of those were health related, some of them were total compensation related, some of them were, oh gosh, I'm trying to remember some of the things, but they were pretty creative. I mean, and it was kind of fun because it was very collaborative. Everybody was like, oh, we gotta get, our mill rate is too high, we gotta get that within the range. And so there was a collaborative effort, but it was a different time, and you're coming out, I don't want to be critical because you're coming out of COVID, there were extraordinary needs these last few years, right, that we didn't have. And we were in the mode of coming out of 2008, remember back then, how tough that was, so people were still a little gun shy. At the time, Malloy was governor and was constantly threatening to cut budgets, or it was just a different mindset back then in some ways. But to your point, I mean, it's using the basic, and to Lee's expertise, you're very fortunate you have him right now, zero-based budgeting. It was looking at, you start with looking at open and unfilled positions. How many do you need to fill them? How long has it been open? Is there another position that would be better filled by that? You know, at a less cost or maybe more cost, and you don't fill two positions. So it was that we did shared positions with Bloomfield. I mean, actually I have a book I can show you, and they have.
I would love to see it. I mean, I think those are thoughtful things we should always be considering. And, you know, one thing with COVID, a lot of things were added that are, the intention is temporary, and it just seems that every time a line item is added, it never goes away. So, you know, it probably is something to think about of when are temporary things temporary enough that the time has come to get rid of that line item, because I think that doesn't happen that often. So I just love to have these discussions.
So generally in terms of taxation, we generally try to only fund, you know, temporary things with temporary dollars and not fund an ongoing position or program with temporary dollars, because then you get the whole, and as you say, it's very hard to get rid of it. And realistically, most things are gotten rid of when there's turnover, right? That's when you can look and say, do we need the position? Can we restructure? Should we realign? And sometimes it means giving a pay raise to existing employees who have taken on new tasks. It can be really beneficial to the employees. And there are different ways to do that. It's I'm not going to tell you it's easy. And you look at other funding mechanisms also. You know, how can you do this? You look at, are we using fees? You don't want to use, you have to watch fees because it can lead to real inequality and not fairness. But you look at, are we fundraising? Can we do this with a public-private partnership? Those are the kind of things. Lee, what are the sort of big savings that you've seen, that you've initiated and stuff like that?
You're putting me on the spot.
Sorry. You come back, he'll fill you in on the budget thing. I won't put you on this. But generally, there are limited tools you have, right? Because
They are limited. Sometimes reorganization, restructuring of the organization can help, you know, particularly in larger organizations. There's a tendency for bureaucracy to grow, and there being too many layers in the organization, you know, so you cut back the layers, you cut back the number of direct reports, you know, i.e. department heads, consolidate departments, that sort of thing. To me, going forward, the big dollars are in the benefit area. You know, those are the fast-growing things, the medical costs, the pensions. And so over time, those things, they need to be tackled. You know, they need to be re-tackled. You know, you can't just do it once and set it aside, you have to continually look for ways to reduce those
Here's one thing you already told me.
ever-increasing costs.
You already told me you're gonna look at attorney's fees for labor
Yes.
attorney.
Yes.
You know, is there a way, because those have exploded in the last few years, and the question is do you go out to RFP, or is there a one-time cause that we think will dissipate, you know? Do those types of evaluation, but one of the things we did, I think, we added a high deductible plan, that saved a lot of money in healthcare. So, I mean, you have to look at it all, it's hard, I don't have an answer.
Shared services is another opportunity, you know, the town's done, I think, a very good job in that area, and there's probably additional opportunities there.
Yeah, so I mean, it's hard. Remember, 70% of your budget is salary and benefits. Board of Ed, 85% of their budget is salary and benefits. So that, really, the big thing is in capital. That's where you can move the budget and benefits. You're getting a cheaper, not less quality, but same quality health at a less expensive cost is one thing you can do, offering different plans, different.
Yep.
The key is to do it high quality at a lower cost, not to sacrifice the quality. And, you know, because we do have great employees, and we're fortunate for that. Want to support them as best we can.
Question for Leah, sorry to make you repeat yourself. When is the meet the candidate again? Meet the town manager?
Next Tuesday, the 26th, from 6 PM to 7:30 PM in the training room of the main fire station
Okay,
right down the
perfect.
street.
Thank you.
You're
And,
welcome.
and how many candidates were there?
We started with a pool of 36 candidates,
Wow.
and the consultant divvied them up among several categories, those that he strongly recommended be considered, those that are sort of on the bubble, and those that they clearly
Or
did
pass.
not meet the criteria.
Yep.
And so the Board of Selectmen as a group reviewed a list of 8 well-qualified candidates. And they reduced that to a group of 4 as semifinalists that they interviewed individually by Zoom last Friday.
Mm-hmm.
And they were able to get that group of 4 down to 1.
So if after the feedback from the Tuesday meeting, if is the plan B to maybe go back to a subset of 2 others if nobody likes this person? I mean, what's
the initial decision, if you will, preliminary, let me call it preliminary
Yeah.
decision that the board has made is that if this candidate, for whatever reason, is not able to be brought on board, the board doesn't decide to move forward, or the candidate decides not to come here, their preliminary decision is go out again,
Yep.
re-advertise,
Oh.
get a new pool. Yeah. So we'll
So
see.
if I come in, do you mean he's from out of town?
The number 1 candidate is from out of town. Yes.
Lee, what, will the new board have any say in this selection?
The new people who are running for the board are being encouraged, I think by their respective parties, to attend the public reception and give their feedback to the current board.
Okay. Try and make it.
I don't envy that person next Tuesday. Thank you, whoever you are.
It'll be lovely.
I hope so.
All right. Let's see, I did send Amy some minutes changes, so we're gonna go ahead and table that and keep it as a draft, and we'll get Amy to recirculate those changes, because they were a few of them were substantive, so I just wanna make sure you guys have reviewed them. And then we have the communications. Amy, did you wanna speak a little bit about, sing a little bit about that rating we got?
I don't know if I've looked at it since we got it. We have a stable outlook as we typically do. It was reaffirmed by S&P. The main factors included our fund balance level, the management score, the policies. You'll see that there's some data that they gave for the economy, for the historical information. George did a great presentation during our call on the economic portion of what's coming down the line.
Is there a PowerPoint on that you could share with us?
Yeah, sure.
Okay, thank you.
The one thing that they noted for a potential downside scenario, they would lower the rating if the budgetary performance were to deteriorate, which would lead to sharp reserve drawdown. So as long as we're maintaining our reserves and not cutting our budget too close, we should have no issues. Our OPEB was 104% funded. Strong management with strong management policies, practices, strong budgetary performance, manageable debt, kind of some of our consistent themes for each credit rating we've received.
And I understand you're doing a review of AAA comparison towns. Can you talk a little bit about that and when we can expect that?
That is actually coming out of Lee's office.
That's my initiative. We have an outstanding acting management specialist, a recent UConn MPA grad who has wonderful research skills. So I asked him to do a little project to take all of the AAA communities in Connecticut. Right now there are 15 of them. And
How many, Lee?
15
Out of how many?
out of 169.
And Simsbury is one of those?
Yes, Simsbury is
Just checking.
Simsbury and the other 14 are in, among the top 10% of the communities in the state that have had AAAs for many years, and I'm sure will keep that AAA for many years to come, given the policies and the management ability of the staff, et cetera. So out of curiosity, I wanted to see how the various towns compare in terms of financial policies, primarily. I don't know what the results are yet. As soon as we get a report and share it internally, Amy hasn't seen it yet either, and we're satisfied with the information, that it's accurate information, we will share that with you, and I think it'll be very interesting to see how the various towns compare, and then you can use it for future decision-making.
His name is Franklin, you said?
Franklin Baruco, I think is how you
So
pronounce
I
his
had the
last
opportunity to
name.
meet him today. He is just outstanding. What a
Yes.
lovely individual.
Yes, yeah. We've been very fortunate in that regard, and we also have a current UConn MPA student, Jessica Power, who's an intern with us between now and May, and she's jumped in with both feet, also doing research for us on
Excellent.
various matters.
Well, thank you. We're
Amy, you said that the bond rating will remain stable if there's no budget deterioration. What would constitute budget deterioration?
If we're not hitting our budget and we're going into reserves to make up the balance.
Yeah, that's the key thing.
So that's part of the reason why the monthly financial reports are so important. They're actually not for internal, because Amy and Lee have internal stuff. They're actually for the policy boards, the rating agencies, and the public. And they help the public gauge, are we hitting our targets? Is there something that we need to be aware of and watch? And that's, GASB, that's actually highlights exactly what you were pointing out. So there isn't budget degradation that we're not aware of.
Do we know what the rating is for the state of Connecticut?
I used to
I
know.
Don't know.
I'm just curious, 'cause,
Yeah, it's not AAA.
No.
it's out of our control.
Yes.
You know what the
What the state does with its money, but being a town within that state may
Moody's raised us from A1 to AA3 in 2021.
What, state or?
The state, Connecticut.
Oh, I was gonna say,
Yeah.
we've been AAA
You
for a
said
while.
us.
Well, we are,
Us
yes,
is
we are
us.
Simsbury,
We are still
we are
us.
also Connecticut.
So
so-
S&P and Moody, that's the equivalent of a AAA rating for.
Yeah, they have different.
Right.
So,
Thanks.
alright, and then, you also have in our packets just what the state of Connecticut asked, and the reason why that's so important, because often when the state of Connecticut asks for something, nothing good comes from it on our, on our end, so it's always good to know what information they're looking for. Hopefully that's changed. But that's why I did want to make sure that one of the things they did ask about was fees, so I wanted to get that on the record, because we do monitor that regularly.
And thank you for pulling it together on relatively short notice.
I can reassure you that the reason for the state requesting that information is to solicit information that might be helpful in modifying the municipal employees' retirement system. So they're not looking to harm the municipalities in any way.
So I'm a little traumatized from past.
Thank you for that.
That is helpful to know. All right, is there anything else for the good of the order? May I take a motion to adjourn?
So moved.
I'll second it.
Any further discussion? All in favor, please say aye.
Aye.
We are adjourned. Thank you very much, everyone.